you all for joining us this afternoon for an RIA's Guide to Harnessing Behavioral Investing. We've got a great crew online to talk about our subject. I'm Chief Marketing Officer with Adhesion. Glad to have you all on board. We're going to hear from Barrett Ayers, who's our Chief Solutions Officer. Great insights about how the intersection of behavioral finance and behavioral-driven portfolios are driving a lot of advisors to new levels on their business success. We're really excited to have Rob Weller from Sterling Capital on board. Ty McDaniel, who's our Managing Director for Sales, is also going to give us some practical applications. So please hang on until the end of this call. Ty's got some really powerful tools that he's going to show you that you can use to help apply this to your practice. So just by way of preparation, we're going to do just a real quick high-level conversation about what is behavioral finance, and then we're going to dive right into how you can leverage that. And then, as I said, Ty is going to pull that all together for us. There's going to be plenty of time for question and answer, and you can ask questions any time during this session. If you'll notice in your GoToWebinar toolbar, there's a space called questions, and you can absolutely use that to pipe in any questions you may have at the time. We'll try to get to all of them as time allows during this session, and if we don't get to all of them, we'll make sure we get back to you after the call is over. A couple of other housekeeping things. This session is being recorded. There will be a follow-up email that will come to you. It'll probably be about lunchtime tomorrow by the time they get done cleaning up the recording and getting it posted. You should get a follow-up email tomorrow morning that gives you the link so you can hear the replay. We'll also have some information about future webinar events that we have, as well as a downloadable PDF that you can use to talk about behavioral finance in your practice. So questions and answers, you're going to get a follow-up recording, and this is really an interactive session. What we'd like to do is start with a quick poll question. How many of you are currently using behavioral profiling in your practice? How many of you are currently using behavioral profiling in your practice? I know most of us use some form of risk tolerance questionnaire, but if you happen to be using some integration of the behavioral questioning with that, we'd like to know. So simple yes or no answer. The answers to all these poll questions are anonymous. We're going to share the results with everybody as soon as we get the votes all tallied. And it's kind of enlightening to kind of understand where our peers are set. So if you'll just take a couple more seconds, are you currently using some type of behavioral profiling in your practice? Yes or no? All votes count. Come on, jump on. Just a couple more of you to go. Here we go. Terrific. It looks like we have 71% who are not using and 29% who are using it. So that's kind of interesting information for us to start with. That's important to us at Adhesion because we're really focused on helping advisors drive value in their practices. And this behavioral finance component is an important part of that. So from our perspective, what we're focused on is helping you increase the value that you provide to your clients. And we call that alpha. That's the value that you bring to your clients above and beyond investment returns. We're going to talk a lot more about this advisor alpha concept in future weeks, but this behavioral component is an important part of it for us. If you don't know Adhesion Wealth Advisor Solutions yet, we're a $12 billion firm. We've been in business since 1999, and what a lot of our clients really appreciate is the fact that all of our development work, all of our operations, and all of our customer support are 100% U.S.-based in Charlotte, North Carolina. So it's a completely local, grown, U.S.-based company for your support. So let's go ahead and close out the poll, and we'll move on to what is behavioral finance. Barrett Ayers, take it away.
Hey, Jack. Actually, so what we're going to do is we're going to introduce Rob Weller. He's a director here with Sterling Capital. Rob's going to provide a little bit of a backdrop on what is behavioral finance, how it works, the history of it, so we can kind of set the stage for talking about kind of the action plan, understanding how to harness some of those behavioral predispositions. So with that, I'm going to hand over to Rob, and take it away, Rob.
Great. Thanks, Barrett. So at a high level, behavioral finance is quite simply how fear, greed, and biases influence investment decisions of individuals and institutions. Behavioral finance as a concept can largely be traced back to the late 1970s and a seminal work done by a gentleman by the name of Amos Tversky and Daniel Kahneman, who later received the Nobel Prize in Economics for the work that they did in the late 1970s on that behavioral finance concept. That said, I'd like to turn it back to Barrett to explore how you can use behavioral finance concepts in your practices today.
Perfect. So, so this is Barrett. And so I think, it's really important to understand kind of the background and the fact that these behavioral biases and predispositions do tend to exist. Not only do our clients tend to exhibit them, we obviously have our own emotional predispositions. And they influence the way we deliver information. They also influence the way our clients process information. So it's very important to understand how to take this knowledge that these biases exist and basically harness them into your practice. So we're going to be talking about kind of a 3-step action plan on how to transform your practice by harnessing these predisposition and biases. So the first thing we're going to talk about is how to plan for them. So the first comment I'm going to put up there is one that I guess we've been told is a little bit controversial, and I will maintain that your client's investment objective is just as important as understanding their behavioral predisposition. So understanding their investment objective from your perspective is just as important as understanding their emotional predisposition. All of our objectives on this call and in this room and folks that are listening to this presentation, all of our objectives are to try to keep our clients as fully invested as possible, following our investment advice and staying the course. So in order to do that, not only do we have to have sound investment ideas, we also have to ensure that we deliver them in a way that's processed and communicated to our clients in a way that makes sense to them. It doesn't scare them off, doesn't concern them and invoke fear. So it's very important to understand behavior types as well as investment types. To do that, one of the ways that we recommend understanding their behavioral predispositions and how to handle them is putting together what we call a behavioral diagnostic framework. A diagnostic framework is a process by which we suggest you categorize and catalog your clients by going through a questionnaire process. One of the models that we tend to use, well, there are many models, is one developed by a gentleman by the name of Michael Pompiane, a model called Behavioral Alpha. In Behavioral Alpha, Mr. Pompiane attempts to decode and kind of decrypt each one of these behavioral tendencies by asking a series of questions, which then points to one of a handful of different behavior types. We will cover these behavior types in the next slide. So it's very important, we think, to also understand, to go through this diagnostic process is to incorporate, as Jack mentioned earlier in the presentation, very important to incorporate behavioral type questions into your upfront profiling questionnaire process. So again, we're trying to connect with our clients on an emotional level, and the profiling process, by way of usually an electronic questionnaire or some other form of collecting kind of risk-based questions, is a really good way to try to understand the behavioral tendencies in an attempt to connect on a more emotional level. So we at Adhesion have a electronic questionnaire. We will talk about it here in just a moment. It can be modified to incorporate some of these behavioral questions. So what does that look like then? Effectively, in terms of the diagnostic framework, one that is, again, popularized by Michael Pompiane is the Behavioral Alpha. The first is measuring the degree of client engagement. And we measure that by their level of participation in terms of both active and passive engagement. And that's not just necessarily the active and passive investments. What we're really talking about here is what are their personality tendencies? Are they very active and hyper? Do they tend to look at market values and refresh the custodial websites and check market value changes and real-time stock quotes? Are they calling you every day or texting you every day? Or are they more laid back? Are they more focused on the longer term and the bigger picture? So you probably have each of those client types in your practice today. Next, let's talk about then linking in the degree of risk-taking your clients are comfortable taking. And this is probably the traditional risk spectrum, the traditional risk questionnaire and profiling you're doing today. How much appetite can your client take? So the next one, which is particularly unique in this particular model is something we call emotional predisposition. And that's layering in those questions that are attempting to measure the emotional predisposition. We put those in terms of both emotional and cognitive. So emotional is obviously, is it more gut? Is it more instinctive? Or are the decision-making, is it more cognitive and scientific in the rationalization process? So using those three inputs to kind of the questionnaire and profiling process, it can point to one of four different, what we call investor behavior types, which we'll talk about in just a moment. Before we move forward from this, though, I do want to highlight and emphasize this is one attempt to kind of codify and decrypt behavioral biases. This is called behavioral alpha. There are many other methods by which you can interpret behavioral disposition. This is one. The platform is very open, very modular, and it can be modified to use other behavioral profiling systems. So what I'd like to do now is I'd like to jump into each one of these behavior types and talk a little bit about what they are, some of the predispositions they tend to exhibit, some of the things that you can consider in terms of very tangible takeaways, and then finally, if you were to use an investment program from Adhesion, some of the ways you can tailor that program to satisfy the emotional predisposition of this particular client type. So that's what we're going to be talking about. So the first one is the passive preserver. You can think of this as the very conservative investor, somebody who's been kind of plodding along on their investment plan for many years now. They have, in many cases, have an emotional attachment to their investments. That could be through, again, slow and steady type investing, or it could have been passed along from an inheritance or some sort of multi-generational wealth transfer. In all cases, they have an emotional attachment to their wealth through a very conservative investment approach. They tend to be more passive in their engagement. They're very low risk, and they make very emotional decisions. The result is they tend to exhibit a variety of traits. One that we're going to talk about real quickly is what we call endowment bias. And an endowment bias is a condition whereby a client or any person for that matter exhibits an emotional attachment to an object, any object. In investments, that tends to manifest itself as an attachment to a stock. In many cases, you've probably encountered these clients. Maybe they inherited 1,000 shares of Exxon from their passed away grandmother. And there's now this emotional attachment to that security. It's very difficult to unwind and separate the client from that particular stock. And it generally doesn't tend to contribute to the betterment of the portfolio. It is a concentrated position. It's probably a very low basis position, and it's probably not helping in your portfolio construction efforts. In terms of advisor takeaways, some of the things you may want to consider with this particular client, they're usually relatively new to the concepts of investments. They probably have not been terribly active in their own investments. They've been very probably conservatively investing. It's very important that you focus on the big picture. Long-term investment planning is key here. It is absolutely critical that we avoid statistics and jargon, and kind of nuanced investment conversations. It generally tends to alienate these clients. And again, our objective here is try to make an emotional connection with the client on a level that they understand and appreciate. So avoid statistics and jargon. Lots of basic conversations with these clients. Because these clients are also emotional in nature, some of the things that we recognize, we suggest with the Adhesion program in building out asset allocations and strategies, you may want to consider building customized strategies. Now, in the Adhesion platform, that doesn't necessarily mean you need to create a one-off portfolio for this client. You can develop your standardized set of strategies on the platform, but then build one-off rules for this particular client. So maybe you're going to put them in a moderate growth strategy, but we're going to do some kind of one-off things for this particular client. Maybe we want to take that low basis position of Exxon and put it in what we call a carve-out sleeve. Move it off to the side, build a traditional strategy for the client, put Exxon off to the side. In fact, we do something called a roaming carve-out with our unified managed accounts, and that's where I can move that Exxon into and out of the managed part of the portfolio as the managers are buying and selling Exxon. We're not actually buying or selling them or affecting any trades. We're effectively moving that Exxon stock into and out of the portfolio and simulating a transaction. We can also put in things like underweight energy stocks because we have an over-concentrated position, or we can also talk about putting in a aggressive opportunistic harvesting program for this particular client, where we can basically talk about unwinding that Exxon stock as we absorb and create losses in the core portfolio. Again, what we're trying to do here is connect emotionally and reframe the conversation as something a little more positive, like harvesting. So now we've neutralized the tax impact and reduced the emotional distress for this particular client. So moving on to the next client type, we have what we call the friendly follower. And these are the clients who are very prone to outside influences. They generally will tend to hear things either in a cocktail party. A lot of times they'll listen to CNBC or read something in the Wall Street Journal, and then they rush to go implement that strategy the very next day. Whether or not it's appropriate for them or not is usually outside the scope of that particular implementation. So these tend to be very passive clients with low risk profiles, yet they're very cognitive and scientific in their decision-making process. One of the behavioral traits that they tend to exhibit is what we call cognitive dissonance bias, and that is a tendency to severely over-rationalize their decisions in investments that tends to manifest itself as things like pointing to the Wall Street Journal and saying, well, if it was in the Wall Street Journal and I read it, it must be true. So consequently, it must be good for my portfolio. Obviously, having conversations to unwind that particular presupposition is key. So some of the things we recommend for advisors is to consider other fact-based deliverables, other educational-based documents and explanations is key. You're trying to counterbalance the effect of the Wall Street Journal article or what they heard in the cocktail party. So providing them with equally substantiated information to support your investment approach is key here. Keep in mind these client types tend to overestimate the amount of risk. Again, they're following trends. They're very tactical and short-sighted in their investment decisions. As it relates to building an investment program, we strongly recommend the use of standardized strategies. Because they're cognitive and scientific in the way they think about things, they can be convinced to see things your way, right? If you provide the right degree of information, the right degree of fact-based deliverables, they can be convinced. I put down here core satellite strategies make a little bit of sense here too, and we're going to talk a little about that in a moment. Some of these client types want to have their accounts managed and overseen by an investment advisor, but they're lacking the sexiness and kind of the movement, and they're missing something to kind of counterbalance that cocktail party fodder. So in these cases, it makes sense for some of these clients, as appropriate, as you deem appropriate, to put them in maybe core satellite strategies that do have a little bit more of a tactical kind of rotation and tilt to them. We think that makes a whole lot of sense. So moving forward to the third investor type, we have what's called the independent individualists. These are the folks that are a little bit more higher on the risk scale, a little bit more active in terms of their relationship activity, and then they're also more scientific in nature. You can think of this as your engineers, and I'm sure you probably can envision the engineer profile type in your practice. These are the folks that do a lot of their own research. They have access to lots of forms of information. They're used to researching things in their personal, in their professional careers. They tend to think of things in very black and white perspectives, very binary. Things are yes or no. So it's very important in these cases to also provide them with other sorts of fact-based deliverables because they tend to fall victim to what we call confirmation or fitting bias. That's where they tend to seek out and provide a lot of credence to fact-based deliverables that support their ideas, yet they tend to de-accentuate and not focus on so much stuff that doesn't necessarily support their position. In terms of takeaways, we think it's really important to collaborate on asset allocation with them. Really good fact-based deliverables. These folks really like to read. They really like to get into the machine, understand how it's built. So to the extent that you can provide optics into the way the alarm clock was built, see the cogs, see how it works, that's really key here too. They're probably not going to embrace a quote-unquote plan. So it's really important that we put together a program that does work, that does fit to their kind of personality and profile. In terms of an investment program, we think use of standardized strategies does make a lot of sense. Again, they're cognitive in their reasoning. So the ability to kind of take a standardized strategy, provide background for it and documentation to support the approach, you can generally tend to convince them your way is the right way. However, again, they want to see the cogs. They want to see the way the machine's built. So the ability to provide them with visibility and optics into the program is really, really important. As an example, with the Adhesion platform, we do have what's called sleeve-based analytics. So if for the right client, you wanted to show them a high-level program results, program performance, program allocations, you can. but you can also let them drill down if it's appropriate. So look at how the managers are doing from a performance perspective. Let them see the trades that are happening down in the performance, down in the manager level. That's available as well. We think that most of these clients prefer more active reporting, so putting them on a more monthly, more frequent, like monthly reporting cycle makes a lot of sense here too. The very last behavioral type is what we call active accumulators. These folks are kind of now at the top of the risk spectrum. They generally have accumulated a little bit more wealth. Very emotionally driven, however. You can think of this persona as the physician or the entrepreneur. Folks that have experienced usually a pretty good amount of success in their own professional careers that has spilled over to their personal lives. One of the traits that they tend to exhibit is what's called illusion of control bias. That's where they believe that they can if they can control all the inputs to the equation, they can somehow control the output of the equation, which again, as we all know, does not convert and translate very well to investment success. However, it's what they've done all their lives, and they feel that they can then take what they've done in their own personal careers and then translate that to investment success. So they will probably push you in terms of making changes to the investment program. If things aren't working the way they expect to in very short windows, they will probably push you to make changes to the investment program. Obviously, it's important not to capitulate to your client investment demands because they will happen frequently. However, moving down to the adhesion program emphasis area, we do recommend considering use of customized strategies. Again, from our perspective, that means taking a standardized strategy and allowing the clients to kind of influence some of the flavors of that program. So that might mean something like taking in compliance restrictions or maybe lifestyle restrictions. Maybe they want to underweight certain drug stocks or underweight or overweight certain pharmaceuticals. Taking some of that information, layering it on top of a standardized strategy to allow the client to think that they're influencing and you're kind of yielding to some of their own professional knowledge. We do think that as you're inheriting some of these relationships, knowing some of their investment prowess, it is likely there will be lots of losses kind of stacked up in these portfolios. So turning those losses into a positive conversation by reframing it and saying, let's do some harvesting. Nice job in creating all those losses. Let's harvest the heck out of them, and let's use them to offset some of the gains I've created over here in what I've done in your portfolio. Again, reframing it, turning it into a positive, and effectively reducing the emotional distress of that client. Cash management is usually a key here, so putting in cash tolerances in the investment program, ceilings and floors, and also hooking up some of the monitoring capabilities. So if your clients are spending too much or they're exceeding their cash ceilings, alert you to that condition so that you can note in real time that your client has hit a spending threshold. Bringing it to your attention, calling the client, refocusing on what's important. So those are.
Before you move on, Barrett, this is Ty McDaniel. Just a couple of questions kind of on those behavioral types. And and I have two questions. The first one is, are any one of these particular types, do they make better clients? And then the second question would be, of kind of the investment solutions that we design, the advisors design, are there certain vehicles that are better than others, ETFs versus mutual funds versus separate?
Well, yeah, the point is that they're all good clients, right? So all these client types, if handled properly, if we put the right framework in place and we understand them, they can all be terrific clients. And it's an important question because we get asked that a lot. A lot of people think that, the physicians and the engineers are the most difficult clients. It's generally because we're talking to them the wrong way, right? We're talking emotional to somebody who's thinking about things in a scientific approach, and it's not melding, and it doesn't make sense, and the approach is incongruent, and generally they feel like a bad client. This is a way to turn them into a client that you can speak to and then can appreciate the program. In terms of investment vehicles, I would say probably not. I think that's in large part a byproduct of the size of the relationship. We're big fans of separate accounts because we can put customization. We can do lots of very sophisticated tax management on top of a separate account. Fees are generally lower. With our platform, we do provide advisors access to separate accounts that are generally not available, sometimes as low as $25,000 or $50,000 minimums. So in this case, we're product agnostic, but we do think it does allow the use of separate accounts where normally it may not.
Thanks.
So I'm going to, again, I think at the very onset of the conversation, we talked about kind of a three-step plan. The first is to basically kind of plan and understand your client profiles. And in the last slide, we talked about 4 profile types. So what we're going to talk about here in a moment, before I transition on to how to capitalize on behavioral biases, is basically there's 4 profiles. And each of these profiles, we believe you need to have a plan for. So maybe you choose to use another behavioral model where there's 6 profile types. And the point is, as many behavioral profile types as you develop and you appreciate and you choose to use, we think each one of those behavioral profile types has to have a template. It has to have a whole series of services, from investments to the way you report, to the way you talk to your clients. And we're going to transition into the profiling piece in just a moment, but just keep that in the back of your mind. Each of these 4 profiles needs to have a whole series of kind of templates built together for them. So with that in mind, we're going to transition a little bit into how to capitalize on behavioral biases. And from our perspective, that in large part means building an investment program that speaks to not only your client's investment objectives, but again, also to the way that they consume and process information. So we talked a little bit about core satellite. We really like the core satellite for especially the emotionally driven clients, because what it tends to do by blending a large core component with some tactical satellite managers around it, is it tends to dampen and reduce the volatility. And the number one reason we tend to lose clients is the fear of the unknown, the volatility of the markets, and the amplitude resulting from the emotional spikes tends to scare off clients. So anything we can do to kind of reduce the amplitude of that emotion and kind of dampen that volatility is a good thing. And a core satellite is a really good vehicle to reduce the volatility and the emotional amplitude. We're going to talk about this in just a moment, but also anytime we can use rules for rebalancing, rules for tax management, anytime we can use rules, we're sucking the emotion out of the investment timing decision. And that's really important here too. The last thing I'll mention about a core satellite that we think is a very attractive feature is we can allow these satellite managers, especially if they're separate account managers, to roam free, to basically roam unconstrained as it relates to tax management. So the satellite managers can be out there selling securities and short-term gains and being tremendously inefficient as it relates to tax management. And then we can look into the middle in the core component to basically aggressively harvest losses to offset the gains created in the satellite. And the combination of the large core and the smaller satellites, we can generally tend to create kind of a tax-neutral environment for the client. Again, reducing the taxes, reducing the liability means lowering the emotional distress for the client. So moving on, so with that kind of as the backdrop, talking a little about the core module, we're big fans of it. There's a variety of core products you could use. Again, we're an open architecture platform, so we can provide you with different satellite managers, different cores. One of the things that we think works very well here is actually a behavioral finance-driven core. And for that, the segue, I'm going to turn it over to Rob to talk a little about the Sterling behavioral finance core model, which happens to be on the Adhesion platform.
Great. Thanks again, Barrett. So we started off the session with a brief description of what behavioral finance is. Again, simply it's how fear, greed, and biases influence investment decisions. Barrett then went into a little bit of detail on how to use knowledge of these biases in profiling your clients. Well, you can also use knowledge of these biases in building out equity portfolios, which is what we do at Sterling. These biases lead to valuation and momentum anomalies within the equity markets. And whenever you have an understanding of the biases and the anomalies, you should be able to, and in fact we have, built an investment process around that to capitalize upon the behavioral biases. We start off with stock rankings, very simply 1 to 100. Stocks that are ranked 1 either exhibit favorable valuation and or momentum traits, and stocks that rank 100 exhibit poor valuation and or momentum traits. We add on top of that capitalization constraints to make sure we are always in the large cap value style bucket. Then we also have stock weighting constraints, which is another form of risk control And lastly, sector constraints. In the case of the Sterling product, we use GICS 24 industry groups as our sector model. We take all of these components and we put them all together to build a portfolio relative to the Russell 1000 value. The idea behind behavioral-driven portfolios at Sterling is to focus on portfolio construction rather than bottom-up stock selection. And by that, I mean, if you look at the composite portfolio we put together, it is both cheaper than and has more momentum than the underlying index that it seeks to outperform. And again, in this case, it is the Russell 1000 value. That's at a high level how we seek to capitalize on behavioral biases in the equity market. I will pass it back to Barrett now to expand a little bit more.
Yep, absolutely. Thanks. Yeah. So again, we think Core Satellite is a really important vehicle. We think it's very useful in dampening the emotional amplitude of clients. However, there's lots of ways to construct portfolios. Obviously, we're an open architecture platform. We have Core Satellite strategies that are either kind of relatively kind of pre-built. You can build your own Core Satellites. You can build a traditional asset allocation, style-based asset allocation, whatever you think is an appropriate asset allocation for your clients. We can layer on top of any of these portfolio construction approaches things like tax harvesting, automated rebalancing. We're going to talk about some of that here in just a moment. So, again, we talked about a three-step kind of action plan. The first was planning and anticipating biases. Next, we talked just now about how to capitalize and build portfolios. Last thing we're going to do is we've now got our clients, their profile. We know who they are. We know how to talk to them. We've now selected some investments that are appropriate for the way their investment objectives require they be invested and how they kind of consume data. Let's make sure we don't fall into a trap. Let's make sure that we don't fall into our own behavioral biases or other kind of timing and emotional predisposition issues. So the first thing that we recommend, and this probably goes without saying, we think it's really important to continue to have ongoing dialogue with your client. And when I talk about dialogue and communicate with your client, we're not talking about just face-to-face conversations. We're really talking about everything that you put out to your client should be delivered in a way that counterbalances their emotional predisposition. So that means things like, well, first, it does mean face-to-face conversation, but it also means what do their quarterly performance reports look like? What do their statements look like? How does the client portal that they log into, how is it configured? Does it speak to their need for data, or is it very high level? It doesn't let them go down in the details. So all that information, we think, again, putting a template together for a behavior type and then following it through. The second thing that we think is really important is the use of specialists. So when we talk about specialists, we're talking about third-party money managers, separate account managers, and we're also talking about strategists, people that put together not only the asset allocation, but also pick the managers to go into those asset allocations. The good news, Adhesion provides both. So you have the open architecture with the manager roster to build your own strategies and asset allocations, or you can pick one off the shelf from one of our strategists. The important point here about using specialists, there's a handful of them. We've talked a couple times about fact-based deliverables. Many of the managers and strategists provide lots of research, lots of information on their strategies and models. The ability to pass it along to your client to, again, reinforce the message you're trying to deliver is key here. The second, we all have our own behavioral biases. We have our own traits and tendencies. We want to make sure that we don't fall victim to our own biases. We also want to avoid what I call behavioral osmosis, and that's a condition whereby the closer you are to the client, the tendency to inherit some of their own behavioral biases. So that's really important too. Because we're using third-party money managers and strategists who don't know your client, they will certainly not fall victim to that behavioral osmosis. And the last thing, and probably the most important, is the more you're using third-party money managers and strategists, the more you have time for number one. So the more you're allowing yourself to kind of free yourself up to talk to clients. The third thing we recommend, again, in the camp of rule-driven, automated, mechanical, systematic things, is rule-based rebalancing. So again, the more we can suck the emotion out of the equation, the more we can ensure we don't fall victim to some of these behavioral biases. One thing I was going to mention real fast, and we didn't put it up on this particular slide, but every couple of years we go through and we do a study. And we basically look at rebalance effects And we think, and I'm sure most folks on the call here obviously have an appreciation for the importance of rebalancing, but we go through and we stress test a variety of different rebalancing outcomes. We look at a couple different portfolio types. We do kind of a 70-30, a 50-50, and kind of an 80-20 allocation between the IFA, the S&P 500, the Barclays Ag, and we kind of blend them together to a couple large portfolios, and we stress test different rebalancing assumptions. And one of the things that we found over all market cycles, the one that is probably the most dynamic in terms of market cycles is the 2008 to 2012, where we had bull and bear markets, we had protracted bull markets, we had mean reverting markets and trending markets. So that's the window that we tend to go back to. And we found that the use of automated rebalancing makes a lot of sense in all market conditions. In fact, one of the things that we found is, at the very least, doing quarterly rule-driven rebalancing can generally add anywhere from 30 to 40 basis points over no rebalancing. And again, these are using some baseline assumptions. If you move to something more like a 10% band, so let's say we've got each of those three asset classes we talked about, where we put a 10% relative band around each of those asset classes, that can generally add somewhere in the range of about 30 basis points, about 82 basis points over calendar-driven rebalancing. So if we can now put some rules in that say, hey, if these asset classes drift too wide or they drop too low, let's rebalance back to the target. Significant addition in that sense. And then the last thing we talk about, if you wanted to, and some of our clients do this, and this is actually, I think, the last bullet, if you chose to influence or take your own ideas about the market condition we're in, are we in a mean reverting market? Are we in a trending market? Should I have my bands tighter for the whipsaw effect of the mean reverting market, or should I widen my bands to take advantage of running asset classes? If you're comfortable making those sorts of calls and doing what we call active band management, where we want to tighten and widen them, if you get them right, it can add a significant amount of excess return. Again, we don't think rebalancing is a tool by which we're attempting to achieve active returns, but we do think that it's there. We do think rebalancing is a very good tool, however, to control risk, again, dampening and reducing the emotional distress for the client. The last thing we're going to talk about real fast is dollar cost averaging, and then also tax harvesting. So the platform does have the ability to dollar cost average in, so spread that capital out over long periods of time, slowly and systematically deploy that capital into the portfolio, and lastly, the ability to do tax harvesting on losses, turning losses into something positive and reframing the conversation. All very, very important. So again, a three-step plan, three-step action plan. With that, I'm going to turn it over to Ty. He's going to spend a little bit of time talking about the program.
Great. Thanks a lot, Barrett. We're going to talk now a little bit about some specifics on things that Adhesion has done to help you incorporate this behavioral-driven investing into your practice. While I go through this, I'm going to invite Barrett and both Rob to interject on any points that they may want to emphasize on any of these slides on a going-forward basis. So you may hear some additional voices. But that said, the first place that we started, Adhesion built a framework essentially to help you incorporate this behavioral-driven concept into your practice. And there are essentially four basic steps. The first one is kind of identifying behavior types while profiling. Second is delivering your proposal in the context of behavioral-driven investing. Coming up with investment solutions designed with an eye toward behavioral types, and then customizing reporting and communications to different types of behaviors. So that's the basic framework, and we're going to spend just a few minutes walking through each one of these aspects. But before we do that, I think it's important to just kind of take a step back and just kind of level set here. Whether you're considering behavior types or not, incorporating those into your practice or not, a good portion of what we do as advisors is to design client investment solutions. We believe that Adhesion's best and most efficient way to deliver your investment solution is through a unified managed account. So we wanted to take just a minute and walk through the definitions to make sure that we're all on the same page as far as UMAs go. So what we have on the screen here is kind of MMI's description of unified managed accounts, and frankly, it's the one you and I grew up with in the industry for the last 15, 20 years or so. And essentially, it's a single registration, a single account that has multiple managers, multiple asset classes, multiple vehicles in that single account. And together they express kind of an investment management solution. Frankly, if you take a look at this definition, it's a wrapper. All it is a wrapper around kind of an investment delivery process of a variety of different investments. At Adhesion Wealth, we think unified managed accounts have come to the next level. A unified managed account doesn't have to be, and frankly shouldn't be, a wrapper around an investment management solution. We think that the next generation of unified managed account, you should be thinking of it more as a business model, not just a wrapper around investment. We think that you can break down unified managed accounts in a variety of different kind of stages and components, and if you apply the best-in-class providers in each one of those components, you can come up with a best-in-class solution at the end of the day. So that's really what we're trying to do. So let's take just a second and walk through kind of Adhesion's unified managed account solution and describe how it works. So the first step is coming up with that strategy. And Barrett did a very detailed job of walking through what those strategies are. At the end of the day, the strategy is an asset allocation that helps the client reach their investment objectives given their risk tolerance. And in the context of today's conversation, it also has an eye toward those behavioral tendencies and traits of the end client. So that strategy, that solution is designed to fulfill all of those aspects of the client. And clients will be clumped together, and they'll share these kinds of tendencies so they can share these types of strategies. The next step of the process is breaking down the components of that asset allocation and determining the best managers or the best vehicles to actually express those components of the asset allocation. So that could be mutual funds, it could be separately managed accounts, it could be ETFs. It's immaterial as long as that ultimate strategy is delivered. Someone has to pick out those managers, and you have the ability, or the strategist that you partner with, have the ability to actually pick the best in class to express that strategy that was initially developed. Now, what we also recommend is that each strategy doesn't have to have a finite or a very specific set of managers. You could have an ETF-only version of a strategy for clients with low-cost basis. You could have one that combines ETFs and mutual funds for a little bit higher asset level, and then one that incorporates separately managed accounts for high net worth. So that strategy can be expressed in a variety of different composites using the best-in-class managers there. The next step of the process is while we tailored and kind of designed this investment solution at the top level, you have the ability to use those kind of rule-based approaches to customize each one of these to the client's specific objectives and needs. So the next step is kind of identifying the rules that should apply to the delivery of this vehicle, expressing those rules, delivering it to someone like Adhesion who can actually deliver and implement them. So the rules that are specific to clients are listed here. The first one would be active tax management. Not all clients will require it, but for those that do, it's an added benefit to not only provide additional return to their overall portfolio, but also to address kind of the concerns that they've raised through the behavioral side. The second aspect would be restrictions that are available in any particular account. So you can eliminate or restrict any specific security or specific sectors so that you can be very specific to that client's needs or ultimately to their behavior type to try to address that. You also have the ability to minimize and eliminate de minimis trade. So you can have minimum trade sizes in so that the rebalancing process doesn't cause excess activity, which can concern specific types of clients. And then finally, you have the ability to hold unmanaged assets within this unified managed account structure. So that low-cost basis stock example of Exxon is ideal. Not only do we have the ability to manage around that unmanaged position, that low-cost basis stock, it does a couple of other things for you and for the client. It gives you the ability to minimize the number of accounts the client actually holds, so it's a consolidation tool. But more importantly, by having an unmanaged asset or a low-cost basis stock, for example, in this managed portion of the portfolio, it gives you an opportunity to discuss concentration risk with the client every time you have a review. So So if you're reviewing the managed portion of the portfolio and you've got that 1,000 shares of Exxon stock and there's been dislocation in energy markets, you have the ability to talk about the risk of the clients actually experiencing by having that concentration. It makes it easier to transition out for those kinds of passive reserver types. So we're talking about rule-based kind of approaches to customize the account, but rules are maximized by providing judgment. So on top of the rules, we have an overlay portfolio management function. We have actual people who apply judgment to the rules to make sure that they're implemented in a way that makes sense for that particular client. So not only are we talking about these rules, there are other aspects of the relationship that the overlay portfolio manager actually can utilize. So a couple of other kind of aspects that I wanted to point out. We have the ability to manage cash at levels into the account. So every account is treated differently. You have clients who would like to have specific percentages or perhaps absolute dollar amounts always kept in cash at the account level. We have the ability to do that client by client, so you don't have to build cash into a sleeve in the overall strategy. We also have the ability to schedule withdrawals for clients. And for those clients of yours that are using these accounts as a source of income, by having a designated amount of dollars available on a monthly or a quarterly basis for clients to withdraw is extremely beneficial and something that allows you to customize at the client level. And the last point is dollar cost averaging. It can be set up on an account by account level also. So for clients that you have that currently have cash but are jittery about getting into the market, setting up a strategy over 1 or 2 tax years or a number of quarters to dollar cost average into the market makes a lot of sense. So having this kind of leverage of having strategies delivered through various composites, but having customization at the client level is not only a better UMA solution, it allows you to address specific client objections and objectives and help kind of fulfill this behavioral-based investing concept that we're talking about today. So with that kind of level set, I kind of wanted to talk through those 4 components that we talked about as the framework of behavioral-driven investing. So the first one is actually utilizing kind of behavioral concepts in the profiling process with the client. So the profiling process is utilized not only to kind of understand risk tolerances and client objectives, but you also want to identify the components of behavioral traits of those clients so that you can have your output consistent and designed specifically for that client. When I'm talking about output, I'm not only talking about the investment solution, but also the communication methodology and the way you interact with that client and communicate. So that's the first step. So at Adhesion, we have the ability to customize the profiling process. So we do have templated questions that are available that are very specific to behavior type and helping us identify those. And the profiling process for us is that once you walk through the process, we'll overweight and underweight specific questions, which helps us come up with an appropriate solution and will help us identify the behavior types we described before, or behavior types that you may want to identify in your specific practice. So the next step then leads to kind of proposals. And the next step in the process, the questionnaire will lead to the proposal, which we recommend being templated. But you have the ability to actually incorporate other components relative to just quantitative aspects of a proposal. So it's not just about asset allocation and past performance. We would recommend that you incorporate descriptions of your firm's investment philosophy, for example, to help tie in that emotional aspect with the client. And then perhaps also reiterate the service model that your firm provides all of your clients. That should be part of every meeting that you have with your client, not only the initial onboarding meeting, but the investment management proposal process too. So the third aspect and the third point in this process is that we is coming up with those investment solution programs specifically. And a few different things. Again, developing strategies. Either we will work with on those strategies, or we'll defer to the strategies that you currently implement. But at the same time, we think that there are various components that are extremely important. So we think that having pre-configured investment programs is important to take the emotion out of the process, and more structure will guard against kind of those emotional decisions that certain client types put in place when they invest. The second is that you do have to have flexibility in the program too. So for those that have more of a cognitive investment behavioral kind of bent, you have the ability to stress customization and the quantitative output. So you can have both in your book of business, and our platform actually provides and kind of supports both. And then lastly, we talked about the 4 satellite components and kind of concepts to minimize the volatility. Right. The last, the overlay on that then is we can implement kind of investment services that will help kind of support that investment program that you've designed. So that's speaking to the tax aware management that we've done, just cash management, keeping specific cash levels, and then cash withdrawals and dollar cost averaging. Those types of concepts, being able to customize at the client level to address specific behavioral types that we've described. And then the last component is actually the communication aspect, which is the reporting. So we want to provide you with a platform to manage and monitor the level of detail that you provide different client types in the report. So it could be either in the output or in the client portal. Our client portal allows clients to access performance up to the previous day's close, if you like. You have the ability for certain client types to perhaps lock down intervals to review performance only on a monthly or quarter-to-date basis. For other kinds of more detailed type clients, you may want to open it up and allow them to calculate their own performance in any interval that's available. Having the flexibility to actually be able to address that and lock down and specify it for specific types of clients or groups of clients is one of the real benefits of kind of our process. We also have granularity at the sleeve level. So clients who are very interested in kind of the granular look at their portfolio have the ability to understand how the performance is on a relative and absolute basis is being performed at every particular aspect of their portfolio. And then finally, from your desktop standpoint, you have the ability to kind of monitor and review client behavior. So you want to look for clients who are withdrawing excessive amounts of cash, for example. Or you may want to identify clients who are opening up their client portal more frequently than you expected, so that you can make sure that you gauge kind of their behavioral traits appropriately. So if we go to the next point, we'll move on to the next slide. And then the last aspect is, and the fourth point of the framework that we put in place is to allow you to design your own client reports to actually speak to and describe and reflect the behavior types. So those would be the behavior types that we walked through already, or it could be behavior types that you want to actually define. So to be consistent with the presentation that we have, we would suggest passive preservers have more high-level reporting. So asset allocation reports, household overviews, kind of performance at the macro level. Friendly followers are interested in drilling down just a little bit further with drift reports, asset class allocation reports, and having modern portfolio theory type of risk return kind of reporting available. We can incorporate all of those into the end product. Independent individualists may have different types of very sleeve-oriented kind of reporting. And finally, active accumulators are looking at unified managed house holdings. They want to understand where the performance is across all of their holdings, and also kind of the benefits and quantitative benefits of the various aspects of the services that you're providing. So providing tax alpha reports and then showing what their actual returns are net of fees. So with the passive preserver, I just wanted to give you a sense of kind of what that could look like. This is kind of a low risk, low emotional type of investing. And again, very big picture. We have the ability to lock this down for those particular client types. And then if we walk over, we wanted to show you what an active accumulators report could look like at the macro level. It's very high level, but more detail and showing net of fees as well as kind of sleeve level reporting capabilities. So all of this can be designed in consultation with you. We would recommend that you reach out to us and we'll walk through how we can ultimately implement your approach to behavioral investing into your practice. With that, I'll turn it back to Jack.
Thanks, Ty. Great job. Great job, Barrett and Rob. I think you guys handled the two big questions in the middle of the presentation. Thank you very much. One quick note, just to wrap up, I think you can tell our focus is on delivering investment services that are going to enhance your client experience, so you can focus on delivering your advice to your client. So remember we talked about alpha at the beginning of this presentation and our ability to help you deliver more holistic wealth management. And so as you've seen from Barrett and from Ty, our ability to help you with respect to asset management, asset allocation, portfolio manager selection, the ongoing management from a tax perspective, from a rebalancing perspective, all of those services are all in behalf of you to support you in institutionalizing your client experience. So I'm just going to wrap up with this last poll question. If you have just a second, we'd like to know if you're interested in learning more about behavioral-driven portfolio management. Are you interested in learning more about behavioral-driven portfolio management? If you are, click yes. If you're not, click no, and we'll respect that. If those of you that are on the line, go ahead and jump on. And while you're voting, I just wanted to give you a quick heads up. We've got another in our series of building exceptional RIAs webinars coming up. We've got Bob Barris, who's going to be talking about the other alpha factor on Tuesday, December 3rd. If you've got questions that we didn't get to today for Ty or Barrett, you can email them at sales@adhesionwealth.com. And having said that, if you've all cast your votes to wrap up, we sure appreciate it. It looks like a number of you are interested in further conversations, and on that basis, we thank you very much for taking time out of your schedules today to join us. We really appreciate the investment of your time, and we look forward to speaking with you again in the future. Thank you all very much, and have a great day.